Welcome to the Financial Advisor Success Podcast, where you go behind the scenes with financial planner, speaker, and consultant Michael Kitces to hear stories of how leading financial advisors navigated the inevitable challenges that arise on the path to success, and get insight from leading industry consultants about how to break through to the next level in your advisory business. And now here's your host, Michael Kitces.
Welcome, everyone. Welcome to the 407th episode of the Financial Advisor Success Podcast. My guest on today's podcast is Mark Asaro. Mark is the Chief Investment Officer of Noble Wealth Management, an RIA based in Greenwood Village, Colorado, that oversees $320 million in assets under management for 160 client households. What's unique about Mark, though, is how he uses a liability-driven investing approach to build retirement portfolios and manage sequence of return risk, with a particular focus on using closed-end bond funds to generate the income needed to cover his clients' expenses during the early and most financially dangerous years of retirement. In this episode, we talk in depth about Mark's approach to implementing liability-driven investing, or LDI, which involves understanding a client's year-by-year spending needs and then creating an asset allocation designed to generate sufficient income to meet those specific spending liabilities as they come due. How leveraging an LDI approach allows Mark to illustrate to his clients the investment income that will cover their early spending needs so they don't have to worry about selling assets during a market downturn. And how Mark's LDI approach has helped him attract more risk-averse clients who aren't necessarily comfortable with the traditional approach to retirement portfolios, and then helps those clients get comfortable to actually spend more of their money in retirement in the process. We also talk about how Mark actually executes the portfolio construction process using an LDI framework with an overweight allocation of fixed income to build a bond tent in the early years of retirement, and a particular focus on utilizing closed-end bond funds to generate the necessary cash flows efficiently. How Mark leverages the equity component of the portfolio to mitigate the inflation risk associated with a heavy bond allocation for his clients' later years in retirement, and how Mark reallocates assets between the equity and fixed income buckets, not only to replenish fixed income allocations for retirement spending as they're spent down or allocations can drift over time, but also sometimes to go the other direction and use bonds to replenish the stock allocation during market downturns. And be certain to listen to the end, where Mark shares how he and his firm navigated the transition from the insurance to the RIA channel amidst the market downturn of 2022, and how they were able to make the most of the situation by adding exposure to high-yielding bonds in the elevated interest rate environment. Why Mark sees an opportunity for advisors in getting into the weeds of portfolio management, including a focus on macroeconomic trends and behavioral finance instead of just viewing investment management as a commodity. And why Mark ultimately believes the liability-driven investing approach is valuable not only for allowing clients to meet their financial goals, but to help them sleep well at night in the process. And so with that introduction, I hope you enjoyed this episode of the Financial Advisor Success Podcast with Mark Asaro. Welcome, Mark Asaro, to the Financial Advisor Success Podcast.
Thanks for having me.
I really appreciate you joining us today. I'm looking forward to the conversation, and I dare I say, getting to nerd out a little bit on building retirement portfolios. Long one of my favorite topics, having done some research in this area myself, and particularly getting to drill into the area of liability-driven investing, which I know has been the institutional answer to how you invest retirement portfolios since forever, right? Any institution that's got to invest a pension that pays out retirement distributions basically indefinitely, this is the standard investment approach. And it hasn't really fully translated to advisors, at least not as a mainstay. And I know this is something you guys have been doing in your firm for a very long time now. And so I'm just excited to talk about very practically, what is liability driven investing? How does it show up when you do this for individual clients? And just how have you implemented this in practice, doing this with ongoing clients over time? So I appreciate you just joining us to get to talk LDI.
Yeah, I'm excited too. It's a topic that I've long been attracted to as a means for clients who are at or near retirement for managing their portfolios. Because what I saw over the course of the 2.5 decades that I've been doing this is a lot of people retiring at just the wrong time.
Yep.
And I can remember one of your podcasts, it was just a few years ago now, where you guys talked about how you can't pick the year you were born as a means of making sure that you have a successful retirement, right?
Right.
Um, and so, we had the dot-com bubble in the early 2000s. Then, of course, we had the financial crisis in '08, and then again in early 2020 we had the COVID crisis, where we saw returns or the markets fall by 30, 40, even 50+%. And for a client who, I can recall pretty clearly one client literally retiring August of 2008. And then all of a sudden, boom, the markets, fall out from under them, and almost immediately 30% of their money's gone. And the feeling they had, the panic, and just the sheer fear they had about their retirement being in jeopardy, um, troubled me, and so
Yeah.
that was on my mind for a long time. Um,
S-
Go ahead.
So as we dive into this subject, I think to start, just for folks who aren't familiar, can you bring us up to speed a little bit about what liability-driven investing is in the first place? And not necessarily
Yep.
for retirees, just kind of the general investment thesis of
Yeah.
what this is and how it works.
So liability-driven investing, a lot of people know it as ALM, or asset liability matching. And that's simply, in the insurance industry, or the pension industry, where you're forecasting out a liability in the future in specific years. So, X dollars in 2026, Y dollars in 2027, and Z dollars in 2028, and making sure that in those specific years, your portfolio is producing that same amount of income. In other words, you're never having to sell an asset in order to meet a liability that's coming up in the future. And so
So
liability driven investing is just simply matching that income with the liability.
so I'm in a pension context. My liability. This isn't a debt mortgage. Meet my credit card and mortgage liabilities.
Right.
This is I'm a pension fund. I need to pay out. Well, I guess whatever's the scale. Yeah, $117 million to all of my pensioners in 2026, and I have
Yep.
to pay out another 118 in 2028. And obviously, when you get pension funds and the like, where you have lots of people involved, and you can predict mortality with law of large numbers, you can
Hmm.
get pretty darn accurate of
Right.
exactly how much money you're going to need to write in retirement distributions in any particular year. And so you're just basically buying things that will produce the cash flow in the required year. I guess buying.
That's exactly right. And really, what we're trying to solve, though, and I always try to think of things in what problem are we solving? Um, Primarily, when we're thinking about asset liability matching, or liability driven investing, we are solving for sequence of returns risk, right? Which is a topic I know you've covered many, many
Yep.
times. And if you are not withdrawing from the portfolio, then you don't really have the same issue as you do when you are withdrawing from the portfolio, because the person who's not withdrawing is not selling down, right? So the market falls 30%, and if you're not withdrawing, all that money is there for the eventual recovery.
Right.
But a portfolio where there is a component of some kind of withdrawal or distribution coming from it, is potentially in a position where they're going to have to sell down. And selling down means that money is not in there for the eventual recovery, and that's how you get opened up to sequence of returns risk. But if the portfolio is producing income in the same amount as the liability or the withdrawal, then you're never having to sell down, right? And so that mitigates a lot of that sequence of returns risk.
But I guess with the caveat in pension land and ostensibly in
Yep.
retiree land that we'll get to as well, our distribution requirements may be high enough that I can't literally just buy bonds, spend the coupon yield
Right.
to cover the income. I guess that the challenge to all of this is my income, at least as traditionally defined, my interest and dividends might not be enough to make this math, particularly for
And
most
that's kind
of
of
the past 15 years.
right, and
The
that's
great example.
exactly what I was going to say. For most of the post financial crisis period, you're absolutely right. The bond sleeves would not produce enough to especially if they're individual, investment grade corporate bonds, not produce enough to cover the spending requirement, right? And so then you're in a position where you're either, maybe buying an annuity or complementing it in some other fashion. Obviously, post really just the last 2 years, where interest rates have come, markedly higher, we have been able to just do it with individual bonds. But in my past life, I got exposed to an area of the securities world called closed-end fund, which slightly differs from an open-end mutual fund in that the fund is literally closed. They trade on a stock exchange, so they're liquid, where you can buy and sell them every day, just like you would a stock or ETF. And those tend to have pretty significantly higher yields. So for most of the post '08 period, we were primarily using closed-end bond funds to kind of, let's call it, juice the yield a little bit to produce more income, to get more in line with where the spending requirement was.
So how does this work with individual clients? Like, how do you translate this over to individual households where I'm not just paying, X dollars of pension for life or for indefinite time period? Like, I've got different cash flow needs that go up and down as the
Yep.
client has their retirement goals and circumstances shift. And I don't even exactly know what the time horizon is, because mortality is easy to predict in the aggregate, not so much for any individual one
Exactly.
human being
Yeah.
that I'm seeing across from. So how does this start to work when you try to translate to individual client households?
So there's some things that make it easier when you're transferring it to a client household, and some things are obviously more difficult. You kind of highlighted a few of the more difficult aspects of just the mortality piece, right? Most of the clients that we are working with are baby boomers. Our firm is a baby boomer clientele, even though none of the partners and principals at the firm are baby boomers. Almost all of our clients are, and so we have a clear specialty in that area. But what we've learned from working with these people for, you know, 2 decades now is you can't predict what's going to happen, right? Any given year, you could have some kind of health issue. You could have a car that needs to be replaced, a roof that needs to be replaced. So just like you can't, predict the mortality, you also can't predict the spending. So there has to be this kind of cone of possibility, let's call it, in terms of a need from the client. The other thing is, what we found is a lot of these clients that have come to us, who are former business owners, are far more risk averse than, I would say, the average client of their same age. I don't know what that is. If it's something about, oh well, I worked so hard to build this business and monetize it, that I don't want to lose any of that money.
So I get it. So you're attracting maybe a more risk averse clientele
Mhm.
who like the story that you can set up with a asset liability matching, liability driven investing framework. But I'm still trying to understand just how you do this when like we don't necessarily know what the time horizon is that we're building out this bond portfolio, bond ladder, however you
Mhm.
do it, because we don't know what mortality is. And then there's the point you made, like, oh, it's not just we don't know mortality, like we're not even sure how much they need every year.
Yeah.
So like I just hear that, if I'm going to get very literal about liability driven investing, I'm like, so basically we're building liability driven portfolios when we don't actually know what the liabilities are. Like, we don't know how much you're going to need or how many years you're going to need it. So,
Exactly.
so how does this work?
So, I mean, one of the things that I was struck by many years ago, was a chart that actually you put out on your blog, where you showed equity allocation by age, and you showed it being the lowest percentage in equities right at about 60 or 65 years old when they retired.
Mhm.
And as you progressed beyond that 70, 72 age, the equity allocations started to rise. The theory being that your time horizon is shortening, right? And so it actually becomes the time horizon of the legacy, let's call it, the beneficiary of those assets,
Yep.
which is going to be much longer. And so that you can then take on more risk. And so it gets back to that sequence of return piece that we talked about a little
Right.
earlier. And so we're really looking to safeguard or LDI the portfolio really in that red zone of danger that we
Okay.
call it, in terms of between,
Right.
call it 55 and 75. Okay.
Okay. Yeah, I guess I used to frame this as this approach is we're building a bond tent for
The
you, like
bond tent. Yep.
a little tent you can take some safety, take some shelter in, because if you graph the allocation to bonds in that scenario, it kind of looks like a tent, like a little teepee. It builds
Exactly. I
up on one
remember the
side,
bond tent.
builds down on the other end. So it sounds like you guys are framing it in that kind of approach.
Right.
I'm not necessarily trying to build like a lifetime bond ladder
Right.
kind of thing, the way I might for a pension fund, where I can just literally, match the maturity of every bond to every cash flow for the next
Right.
several decades. You're building more like a transition window for
Exactly.
20 or 20 years from your mid-50s to your mid-70s,
Yeah. I mean,
specifically during that, like your peak sequence risk, where you build up a reserve of bonds and then you spend it down as you get through the danger zone.
exactly. So, we use eMoney as our financial planning software. And really, what we see out there is a lot of advisors create the portfolio based on a risk assessment questionnaire, right? And then they basically, if the questionnaire comes back and says, oh, well, Bob Smith can tolerate a 70-30 portfolio, well, then boom, that advisor puts him in a 70-30 portfolio. And that's, I mean, it's not all advisors, but that's what I would say the majority of the industry that we come across is doing with clients that are in that 55 to 75 range. And so when we're doing it, we're looking at we're doing the eMoney piece first. So we're building the plan first, and we get pretty granular with the data. We want to know all the information, get all the Social Security statements, all their expenses, make sure they have an idea what their expenses actually are. I would say 1 out of every 3 prospects that come along really has no idea what they spend on a monthly or annual basis.
Right.
And so getting that in order is kind of numero uno in terms of formulating the portfolio. And once that eMoney plan has been built and gone through with the client, then we can go about and figuring out, okay, so what is the portfolio that's going to get the outcome that we need based on the plan? And that's when we start creating that income stream. And I have a few Excel models and other tools that are used, like Y charts is another thing we use to figure out, okay, so what kind of asset allocation are we looking at here? How much are we putting in individual bonds? How much are we putting in closed-end funds? And figuring out, okay, how much income are we going to conceivably produce from, let's say, 60 or 70% being in bonds, as opposed to 30% or 40% being in bonds.
So help me one step further, just understand, like, how do you actually get from e-money projection to portfolio allocation, bond allocation, how much to buy for which bonds? Like, how does this actually work?
So this is a good question. So we actually have no models, and I know that's probably strange from a lot of people listening are probably going to say, how do you not have a model? Well, I mean, we have what we call as baselines or guidelines, but there is no model where okay, well, this guy fits into this 50-50 model. We hit a button, it buys everything that's in that model. That's not the way we do our business. From the eMoney plan to the portfolio takes a little bit of legwork. It's several hours of over a course of a few days that I'm piling into an Excel spreadsheet to figure out, okay, looking at the plan in eMoney, how much do they need, in year 2 through 5, and then how much income are they going to need annually from year 5 to 10, and then looking to see, okay, what kind of assets am I dealing with here? Is it, am I needing to produce 100,000 of annual income with $1 million or $10 million, right? Because that would obviously change things pretty dramatically. And so from there, I can slowly back into what we think are the best securities. So if their objective says, hey, we can get you, to your objective with a 30-70 portfolio, we're happy putting them in a 30/70 portfolio, so long as the client is okay with that as well.
So as you're building out these, I guess, projections, right? What do they need in years 2 to 5? What do they need in years 5 to 10? Do you then come back to I guess I'm just thinking of like an LDI style? Okay, now I'm going to make a bond ladder to generate these checks in years 2, 3, 4, 5. Maturing the right amount in the right year. Like, is it that kind of implementation, or what do you actually do to translate this to the portfolio?
So for most of our clients, we don't use a bond ladder, and that's simply
Okay.
because for most clients, the withdrawal rate from the portfolio is actually pretty low, and that's more of a function of the clients that we just seem to attract. And so, I went through a bunch of e-money plans, and I would say our average withdrawal rate was actually sub 2%, which is, I
Okay.
think, extremely low. And one of the things I do for our clients is I write memos. I write these client memos every month, or I try to do two a month. And one of them was titled "Overcoming Frugality," and I highlight the book "Die with Zero," which has become pretty popular in our circles, because I said in the memo, one of the things I'm seeing is a chronic underspending by our clients. Well, how does that translate to the portfolios? I don't need to build a bond ladder for 90+% of our clients. I can just have a bond and a mixture of different bonds of varying maturities, plus a complement of those closed-end bond funds that we talked about earlier. And that's going to produce enough of the income that the client needs, especially when you add in Social Security and any other sources of income that they may have to cover their spending and any taxes. And so for the most part, we're not using a bond ladder at all. In fact, I would rather use a diversified portfolio of closed-end funds over a bond ladder any day. And we can go into that if you'd like to.
I want to come back to more about the closed-end funds
Okay.
as soon, but I'm still just trying to visualize all of this, right? I guess
Mhm.
relative to how our industry traditionally teaches us to build portfolios. So I'm kind of hearing a framework of a lot of clients. The actual withdrawal rate from the portfolio isn't necessarily all that high, in part because they've got Social Security and some other resources. And so when you get down to withdrawal rates that may be 2% or sub 2%, I might actually be able to buy enough bonds to yield this. I might even be able to buy enough bonds to yield this without all putting 100% of the money in the bonds in order
Yeah.
to do it. So I get it on that end. But then my brain immediately goes to, okay, but what about impact of inflation on
Yep.
purchasing power bonds if we're doing this for 10, 15, 20 years?
So that's probably the number one, I would say, risk or caveat to the strategy is you're taking a period of time where you're basically earning, let's call it 4.5 to 5.5% nets, net of advisor fees and any other fees, but pre-tax, and taking that income and using it as your spending tool. But during that time, you're not compounding or building the wealth, right? And
Mhm.
so for a lot of clients, to combat inflation. So for a lot of clients, I would rather have a 30/70 or 20/80 portfolio where there's 20 or 30% in stocks that are just sitting there building and growing over the next decade or 2 decades, never touching them, and more so cannibalizing the fixed income portion. So say the fixed income portion covers 75% of their spending needs, which is probably, if the client is, if it's a situation where the bond piece is not covering the expenses portion, it's usually at least 75% of their spending. So it's not like we have a huge shortfall. And our average client asset allocation is now about 30/70. Okay. So in that 30 is really there as the inflation hedge, right? It's compounding over 10 or 20 years. We're not touching it. And any deficit from the income versus what they need to spend on is really coming from the bond side. Okay. And so then you think, okay, well, then you're drawing down some of your bonds. Well, yes, that's true. And over a slow over a longer period of time, you're slowly shifting the asset allocation as well, right?
Okay.
And that goes back to your chart about how, past
Right.
70, 75, that equity allocation starts growing again. And so that's a natural way to get the equity allocation growing again, right? Because you're slowly drawing down some of the fixed income. But really, that's less than a quarter of our clients. Because like I said, the yield today on our fixed income sleeve is probably north of 7.5%. So unless the client is, and if you got 70% in fixed income, 70% being fixed income and 7.5% yield on that 70%.
Right.
For most of clients, you're covering that spending.
Right. I mean,
And
relative to aggregate portfolio, you're yielding almost 5 on, well, like relative to the total portfolio. And if they're spending 2 or 3 because the rest
right,
comes from Social Security, like
exactly.
even after taxes and after fees, like there's just literally enough money from that portion alone.
That's exactly right. So to answer your question, it's that 20 or 30% that's in the stocks that is really to overcome inflation. And we haven't really had to deal with it for a long time, right? It's only been the
Yeah.
last
Right.
couple of years where we've actually had inflation as a bigger risk.
And so is this functionally how it gets implemented? Like literally the distributions get funded by yield from the bonds from the fixed income side. If they need a little more, you may do a liquidation on the fixed income side.
Correct.
And the equities are just kind of in a sleeve off to the side that just sits there and grows
That's
for
exactly right.
5, 10, 15, 20 years, however long until they
Hopefully, right?
have to,
Yeah,
uh,
and we have some caveats and some one-offs in that, but for the vast majority of our clients, that's the way it is. And we have things that sit on top. We have what we call overlays. One of them being a reallocation plan. And that's simply, okay, you're a 20/80 portfolio or you're a 30/70 portfolio. You're getting your income from the bond side of the equation. But say the stock market falls 40 or 50%. Well, we're going to take advantage of that regardless of doing the LDI, and we're going to shift 10, 20, even 30% from the bond side to the equity side to take advantage of that. And then down the road, we can go back to it if need be. But for the most part, clients are okay with being, let's call it, under allocated to equities, because they have that peace of mind, that sleep well at night factor during retirement, that they're still collecting the paycheck. And one of the things we talk about with prospects is, you're for 30 years, call it, post college or post high school, you're taught to work hard, save a portion of your paycheck, build up your nest egg, create wealth, and then suddenly on your, call it, your 65th birthday, you retire,
right.
and all of a sudden you're supposed to like flip a switch and be okay with spending down your savings. Well, even though you've been taught for 30 years not to do that.
Right.
And it's one of those psychological barriers that I think is hard to overcome for clients. And I think this is also a mechanism from a behavioral finance perspective that helps the client overcome that, because I can say to them, we're generating the income. Just think of it just like your paycheck. Right? It's coming to you on a monthly basis, just like your paycheck did. You spend it down just like your paycheck did on your bills and other liabilities. And I think it helps the client, just be a little more at ease with having no real paycheck coming in, and being kind of like we talked about earlier with the business owner, not having, relinquishing the control that you had prior when you were working, and relinquishing that control to Wall Street, basically.
So this helps for context that, functionally, you really are trying to draw all of the distributions from the fixed income side. And so equity stocks in this context is I guess, like, does the multiple duty. It's the growth engine for having enough assets to deal with higher inflation adjusted expenses in
Mm-hmm.
the future. It's compartmentalized, so you can go to clients and say, if the markets are down, like, we won't have to touch any of your stocks. Like, we're literally getting all of your cash from the fixed income portion right now. Oh, and in fact, if stocks really go down, we're going to implement a reallocation plan and buy more of them when they're down
Right.
from our excess bonds. So you don't need to worry about stock market volatility for a long, long time to come. Now we good with stocks.
Exactly. And you summed it up pretty nicely.
So, so I noticed you called it a reallocation plan. Is that different in your mind than calling this rebalancing?
I think so, because rebalancing to me has a connotation where you're systematically keeping the portfolio at the given targets. So if the client's a 60-40, and let's say bonds have a terrible year and stocks have a really good year, and all of a sudden you're 68, 32, then you're just simply rebalancing back to that 60-40 target. Whereas the reallocation plan is really a formulaic based strategy that only kicks in at certain triggers. And so we have a nice chart where we show if the S&P falls 20%, we move 10% from equities, or excuse me, 10% from bonds to equities. If it falls another 10%, so now we're down 30 from the peak, we move another 10%. And so aggregate of 20% over. And then again, another 10%, so peak to trough of 40%, we've now moved 30% over from bonds over to stocks.
Oh, interesting.
So we take the emotional piece from the advisor out of it. So they're not forced to say, okay, well, I think this is the bottom, or I think this is a good time to buy. They don't know any better than the client knows, right? And so by making it systematic and formulaic, we take that emotional component out of it.
And is that literally how you would implement if this was playing out? I mean, like,
Yep.
the market's down 20%, so we're going to fire a 10% allocation. Okay, if it moves down another 10, so now we're down 30 cumulatively, like, we fire another 10% trades. Like,
Exactly right.
you would be buying 10% tranches as the market keeps going down. Because obviously
Exactly right.
You don't know it's going to be peak to trough 40 until after it goes
right.
down.
I mean, so you don't
goes
know,
down
right?
40. So you would just keep pulling these triggers as the portfolio goes down.
Correct. And like I said, with the technology today you have at your fingertips, it makes it so easy to do these things. But sometimes, having these easy, pieces of technology to help us scale our businesses can also be a negative, because it could force you to do things when you really shouldn't be doing anything, because sometimes the best plan is doing nothing. And I think a lot of advisors, and I think a lot of clients, always feel the need to want to do something. But like I said, by making this formulaic, we can easily implement this across the portfolios that have agreed to it, and we can do it with relative ease with everybody at the exact same time. And so it's been one of those things. And really, how many times do we get a 20% bear market? We've really only had a few of them in the last 10 years. So it's not like this is something that we're doing 2 or 3 times a year, right?
And I guess because you're firing when the market, capital T, capital M, like the market S&P falls 20%, like, if the market has a 20% drawdown, you're at this point, you're firing every client at the same time on a reallocation plan, because they're all succumbing to the market is off 20% from the peak.
That's correct, right? And not all clients are in this kind of reallocation plan, but the ones who are, we've segmented and we have those clients ready to go, right?
Who would not be in the reallocation plan?
It's there's no rhyme or reason to which clients want to and which clients don't. There's just a handful of clients that just say, hey, we're okay with the current allocation. We don't need to shift any more to equities. Or there's few that will, if there's a sea of red out on your screen, because the markets are in free fall, like we had in early August, you can hesitate, or you can be very hesitant to want to go into bonds, or excuse me, stocks. And so what is it, Rothschild, who said, when there's blood on the streets, you want to buy. But when the time comes and the opportunity comes, many people don't want to do that. In fact, they want to go the opposite way, and we try to steer them away from that.
So if clients have reallocation plans that trigger, and you're moving 10% tranches, like someone who started out 30-70 could actually get back something closer to 60-40 if the market really fell
Right.
40% plus, and like you pulled the trigger 3 times. So do you ever, is there a reallocation trade back
Back.
the other way? Like, are there exit points when this unwinds, or if the market throws you in more, like, you're in, we bought you cheap, but you're in now?
Absolutely. So the only difference though is the reallocation plan back is not formulaic.
Okay.
So one of the things we tend to look at is, okay, what's the client's overall risk tolerance here? What's their income needs? What's going on in the bond market at the time? How much has the reallocation plan made them? And a lot of people like to see it in dollar terms. Well, by moving over 30% from bonds to stocks, that extra capital has gone up X percent, has netted us, $200,000. We're good with that. Let's realize those and move it over to bonds and lock that in. So that's more on a case by case basis. We have some they just never want to reallocate back, and that's fine too.
Because they do it, like, congratulations, you were bond heavy in the decline, you did buy stocks when they fell, the market presumably has recovered if it generally
Yeah.
does what it does. And so at some point clients might say, okay, apparently I dodged the bullet, I'm up more now, I've got more money than I needed, and we're already several further years in retirement, I guess I'm just gonna chill here
Yep.
because it turned out okay.
Yeah, I mean, we have people who've borrowed from life insurance to put into the stock market when the stock market's fallen. That's their reallocation plan. So it's really client dependent, but a lot of it comes down to just talking with them and feeling them out and seeing how comfortable they are with this new allocation. And usually, I can get a sense from that meeting, even if they say, "Oh, I'm comfortable," whether they really are or not. And then I can say, well, okay, I know you said you were comfortable, but I think we should maybe toggle back the equity risk a little bit. And here's why. And most of the time they'll take my advice.
So in scenarios where it's not awful out of the gate, right? We have the decline and the reallocation plan fires. You get the quote unquote good scenario, right? Like the client who retires right after the COVID meltdown and just powers forward in the recovery, or the client who retires in 2010, 2011, and then gets a rip roaring bull market for almost a decade. In theory, as I would think, if you're always drawing against the fixed income portion and kind of letting the stocks run, if you get a good enough bull market, you could also just get clients that have like a materially rising equity exposure
Yep.
over time, just because stocks are doing well. You started 30-70, but we're 7 years in and you're already back to 50-50.
Yeah.
So are there reallocation plans or rebalancing triggers in those scenarios, or is that again back in it kind of depends on where the client is and how they feel about the way this path is unfolding for them?
Yeah, in those scenarios, we're typically going to rebalance back if they're really out of whack. And honestly, we're looking at that stuff on a monthly basis, anyways. And so mostly for tax loss harvesting purposes. But if we see something that's kind of getting out of whack, we definitely have to make sure that we're in compliance with our asset allocations. And so we either then have to send the client an asset allocation change form because they've gotten so far out of deviation from their original allocation, or we need to rebalance. And typically we're going to just rebalance back because then we've done what we set out to do, which was make money on the equity
Right.
side, and we've done that. So let's harvest some of those gains and make sure that the risk portion of the portfolio is where the client really wants it.
So is there a threshold or a target of how far you're comfortable to allow portfolios to drift before you feel like you need to rebalance the equities back down without setting new asset allocation investment policy statement out?
Yes, we typically look at any account that has a deviation of 10% or more, and then from even there, we may not rebalance.
So So
Go ahead.
meaning like I'm supposed to be at 30 and I'm up at 40, or
Correct.
I'm supposed to be at 30 and I'm at like 33 because that's 10
Oh no,
10%.
10% total allocation. So at
Okay,
40,
okay,
like I said, we don't have a model, so it's not like I can go hit a button, everybody's
right,
rebalanced back to the target. So we're
right,
doing this account by account, and I'm typically going
okay,
through each account, um, you know, at least a few times per month, just going through the holdings, looking and seeing what's happening. But especially at the end of a month, Nate and I are looking at exposure and seeing which accounts have drifted a lot from their original targets. And 10%, meaning 33, is definitely not enough for us to want to rebalance. But 10% equity movement,
right.
meaning 30 to 40, would definitely be starting
Okay.
to raise a flag and get us to start
So
at least moving back towards it, if not 100% back to 30.
so I guess to try to play this on my head though. So it if they drift from 30 to 40, right, we may pull a rebalancing trigger or trade.
Mm-hmm.
But if they get from 30 to 40 in a reallocation plan because markets are down,
Yeah,
we
that's different.
handle that differently because like we're buying because markets are down, not because we just drifted there. Like is that
That
that's
that's
the
correct,
functional difference?
because the target in Black Diamond would be shifted to 40, and so they wouldn't show up on that rebalancing report.
If a reallocation event has to move, you're essentially changing the quote unquote target allocation
Correct.
that you use to generate the drift report to figure out whether rebalancing trades need to occur in the first
That's
place,
correct. That's correct.
because Black Diamond's your monitoring platform. Okay.
That's correct. Yep.
So um so then as you follow this path, it sounds like just a lot of this is built around, well, I guess as you said, the so-called retirement red zone, right, are like 5 to 10 years before until 5 to 10 years after, where sequence return risk does really bad things if you get the wrong
Yeah.
sequence, the wrong time. So is there something that shifts or changes once you get out of that red zone window? Like if clients, God bless, make it to 75 and in theory we're out of the zone, like, does the process or the implementation shift at this point?
So typically, what we're doing is we're looking, obviously meeting with the client, and most of our clients we're meeting with probably semi-annually at this point to gauge kind of what they want to do. A lot of it comes down to their willingness or how risk tolerant they've become, because a lot of times by the time you're 75 or even 75 to 80, somewhere in that zone, or older, you have a lot of flexibility, and so you could either be 80% stocks, or you could be 0% stocks, depending on what's your comfort level. And usually the three partners, we can figure out pretty quickly kind of where the client's head's at in terms of what kind of asset allocation, how much risk they're willing to take.
I'm just envisioning more and more clients kind of get more and
Yep.
more, I was gonna say out of sync. Maybe that's not really the quite the right label, but like everybody's gonna be in a little bit of a different spot, either because they've drifted a little differently depending on when they got in, or when they've had rebalancing triggers or not with outside of a 10% band,
Mhm.
or because some gets the band and you rebalance and others gets the band and say, no, I'm actually feeling pretty good. Like you can hang out here. So just can you talk through what, I don't know, what like in internal process looks like? Just how do you make sure you're up to date on all these clients and where they're supposed to be? Like how do you handle all of it?
So that's actually a good question. That can be the cumbersome part of this. And so when we talk with other advisors, they're really, kind of, let's call it, put off by the way we manage money, because they don't think it's scalable at all. And they want to be able to push a button, and everything's done, and they can move on to the next thing. Obviously, the way we do it, we can't do that, or we choose not to do that. And so it comes down to just knowing. A lot of it is in our dictations that we write, with after we meet with a client, and I literally have notes in an Excel spreadsheet that I keep, with these very factors. So you talk about like the reallocation plan or rebalancing, or the client just doesn't want to wants to keep the portfolio as is now that he's 77. Those types of things. I just kind of have little notes jotted on my spreadsheet where I keep just other notes about the portfolio as well. I can't put a restriction in like Black Diamond or Schwab and say, if I'm trying to buy a tobacco stock or a tobacco bond, flag it for me. There's just not, that technology isn't out yet. There's notes and things like that in Black Diamond, which I use a lot, but there's nothing to prevent you from actually trading on it, which I find very fascinating.
So what's uh so does every client have a spreadsheet that you track what's going on and how their reallocation plans are playing out?
No, I mean, I just have one master spreadsheet with all our clients on it.
Okay.
And it's a lot less sophisticated than you're probably thinking. It literally just says, reallocated 10% from bonds to stocks on this date. And you'll have I have the basic information like the target models and things like that, but nothing too fancy.
Okay.
But it's actually a lot easier than I think I'm conveying it, because there really isn't that many times we've done a reallocation.
Right.
If
Like
you,
this market's only moved that extreme so often. You deal
right.
with
I mean, the
this
last time was
once
early.
or twice a decade, give or take a little.
I mean, we barely got to the 20% in call it late 22, right? In October 22. And even then I hadn't even really started implementing the reallocation plan when it recovered back above the 20% threshold. And so, and I can remember in late 18, when the Fed was raising rates and causing a kind of that little mini bear market. It was there for a fleeting second, and recovered a good portion of it right after Christmas. So some of these times it's hard to implement it on a moment's notice, but it just doesn't happen all that often. So we don't. It's not like something that we're doing on a day to day, month to month, or even year to year basis.
So now help us understand a little bit more how you implement this, like what you buy, what you use, I guess both on the equity end and the fixed income end. Like how does this come together from a portfolio construction end?
I have more of a fixed income background, so on the equity side, I'm typically using ETFs,
Okay.
mostly just passive investments. I can, obviously there's a little bit of discretion in what I can do within the equity bucket. So, for instance, about 3 or 4 months ago, I sold, you know, all the market cap weighted S&P and moved it to either equal rate or into mid and small caps. And like I said, with Black Diamond, you can do that pretty quickly just using the ETFs. So that's primarily the only active stuff that we're really doing on the equity side. But we're doing the traditional buckets of large, mid and small on the U.S. side, international and emerging markets, and then a real estate component in there as well.
Presuming like shifts from market cap weighted to equal weighted was just getting away from
Max.
Mag 7 concentration,
Yep.
that dynamic.
Yeah, I
Okay.
mean, having the CFA, you can do value.
Yeah.
I've been able to do valuation work, and I just look at some of these valuations, and it just boggles my mind. One of the things I like doing is I have a bunch of weekly charts that I look at on a weekly basis, and the valuation differential between large and small U.S. I mean, it was just huge, 4.5 standard deviation spread, and so at that point, the combination of the ridiculous valuations in Mag 7
Mhm.
and that valuation spread between large and small was the trigger I needed to say, okay, time to move some money from market cap
So
weighted to small cap.
so what are your I love nerding out on data. Like what are your like your weekly charts? Like what's your weekly go-to? What do you like
So
to monitor?
yeah, so I mean, I like looking at earnings estimates. A lot of the macro data I look at. I look at jobless claims and things like that for triggers to get a little sense of kind of risk on, risk off. Um, you know, given that I have a fixed income background, I look at the yield curve a lot, just movement of interest rates, and really I like looking at reactions to earnings. There's probably about 2 dozen charts that I have saved on Y charts that I kind of go through on a weekly basis.
And so you're finding these in Y charts as your
For the most
investment
part.
research platform of choice, and then I it's just like have a long list of saved charts, saved reports, and Y charts. So you can like
Yeah.
pull these quickly when you want to rotate through them.
And honestly, if you don't have Y charts, the Fred database, I think, is the most underutilized piece of
Mm.
let's call it technology out there. It's
The,
free.
the Fed's public
Yeah,
database.
the Federal Reserve Bank of I think St. Louis that puts it out. Yeah, the Fed the database is massive, and the amount of data in there rivals a Bloomberg, and it's free. And I
And
just go ahead.
I'm out of curiosity, what led you to Y charts? I mean, as opposed to Bloomberg and other solutions out there.
Well, for one thing, cost. A Bloomberg is outrageously expensive. We moved from Northwestern to Schwab as an independent RA, and while we were at Northwestern, we got a grandfather deal that Northwestern reps got from Y charts. It was a pretty good deal, and so we were able to keep that deal after leaving Northwestern. And so Bloombergs have such granular data that are more geared towards kind of equity research. How many ships are leaving the port in Yemen,
Right.
on a Tuesday? That's the stuff that we don't really care about. It's Y charts has all the data that we really care about.
So help us understand a little bit more how you implement the fixed income side. So you said equities is very ETFs oriented, more passive, right? We're just trying to buy our market exposures, buy our beta, as it were. So now, how does it work on the fixed income side?
So the fixed income side is obviously a little bit more complex, I would say. And I think that lends itself to my background. But what we've seen and what I've kind of noticed over the last 15 years is, you'll get these advisors who admittedly are very smart and great portfolio managers on the equity side, picking individual stocks or doing different things on the equity side. But when it comes to the bond side, they're simply just buying a open-ended mutual fund, like a total bond fund or a total return fund, which to me makes zero sense, because if you can generate an additional 1% on the fixed income side, that can really improve the overall portfolio returns over 5, 10, 15 plus years, because conceivably the fixed income side is going to do well in the pre-COVID environment, 3 to 4%. If you're lucky, maybe now it's 4 to 5. So adding 1% on 4 is a pretty good addition to your return profile. And that's, if you're in a 60-40, that's on 40% of that money. And so, we take that approach and we go even further, not just buying an active, good manager, like, any of the good ones that are out there, but we take it a little step further and we actually go into the account, or excuse me, the asset types. And so moving away from the open-end mutual fund and looking at the wrapper itself of where your bonds are housed, or buying the individual bonds themselves, which is something I haven't done in a number of years, because post 08, it really made no sense to go buy individual bonds because the yields are so low. So we focus a lot on those components and the various pieces of those based on what's going on in the market. And so we had talked a little earlier about closed-end funds, and most people don't know much about them or focus on them at all, but they are a big piece of why we've done so well on the fixed income side. And it's having the patience and studying them for 2 decades that gives me the confidence to build portfolios with them, because there are, admittedly they do carry more risk than an open-end bond fund, but I think that risk is to your actual advantage, because during periods when discounts are very wide, that's like, almost like a reallocation plan where you're buying a dollar's worth of assets for 85 cents on the dollar, or buying a dollar's worth of assets for 85 cents. And so by doing that, you can greatly increase the bond side of the equation of the asset allocation.
So
Go ahead.
can you give us a little bit of, I'll call it a refresher on closed-end funds versus open, and how it shows up the bond context? Just I'm envisioning a lot of us are like, I know I covered closed-end funds in my CFP classes like 7 or 12 years ago, but like I haven't really ever bought any. So it just may help make sure we're on the same page
Yeah.
about how these actually work in the fixed income context. Just make sure we're all synced up here.
Yeah. So closed-end funds have been around a long time. In fact, they've been around longer than the open-end mutual funds that most people use have been. And in fact, Warren Buffett's original investment vehicle was a closed-end fund. So they've been around over 100 years. And essentially, they were the preeminent vehicle of where investors would go for a pooled asset, whether it was stocks or bonds. And really, it didn't shift until kind of the early to mid 70s when Vanguard and Fidelity started coming into the scenes and introducing the open-end fund that the focus moved from closed ends to open ends, and it really came down to marketing. The big companies figured out that they could grow these open end funds to become these massive, scaled, pooled vehicles and make a lot more money. And so they directed all their marketing dollars towards them, and then of course the advent of the 401k around 1980. Shifted so many more of those dollars towards the open-end vehicles that they now dwarf the closed-end side. But the closed-end space is really, we're sub 500 funds at this point, and just a few $100 billion in assets. So it's pennies in the sofa relative to the open-end mutual fund piece and ETFs.
So
yeah.
So like who issues them and why now? Like why? I'm not sure if it's no, but like if we're down to 500 and it's so small, like why hasn't it just gone to zero? I mean, like why isn't everybody just doing this in open-end fund format?
Yeah, I mean, there's some sponsors. Nuveen, BlackRock, and PIMCO are probably the biggest three sponsors of closed-end funds. The reason is simple. They do charge a little higher fee than an open-end fund does because they're not scalable like an open-end fund is. But also, you got to think about it from their point of view. These are captured assets, right? If you sell a closed-end fund, somebody else is buying it. The fee generating revenue or assets under management doesn't change. So, an open-end fund, and these companies have massive amounts of open-end funds. Some of these open-end funds never take off, right? They'll have 30 million of seed capital and never grow. And then they shut them down. Or you can think of it a $2 billion fund that had great performance and suddenly has terrible performance. It goes from $2 billion in assets to 50 million because everybody pulls their money. Whereas a closed-end fund, that can't happen because the assets are captured in this pooled shell.
So so if the thing's unpopular, because at worst, like its price goes down, so you get potential that it trades at a discount to
larger discount, right?
to underlying, but from the asset manager's end, like same holdings in the portfolio, we're billing our same fee.
Correct. And they're still issued with, let's call it relative infrequency. We've only had 3 or 4 per year at the most for the last several years. There's a couple of good free resources out there. One of them, CEFconnect.com, which is put out and sponsored by Nuveen. And the other one is CEFdata.com, which is run by a guy named John Cole Scott out of Richmond, Virginia, who runs CEFA Advisors. And there's tons of data on them, so you can find all the information you need. But from an advisor's standpoint, these things are great tools for retirement because unlike an open-end bond fund, a bond closed-end fund typically pays monthly in cash and at a steady rate. So you can almost think of it, as we talked about earlier, as a paycheck replacement. You know how much income is coming in on a monthly basis and what day it's even coming in. And so when I'm modeling out, as we talked about earlier, those liabilities in terms of the amount of spending they need, a closed-end bond fund is ideally one of the best tools out there, because I know exactly what it's paying and how much the client's going to receive in cash and what day.
So are most of the closed-end bond funds at this point a fixed list of holdings, meaning like whatever was in the thing when it launched and got going, that's what's in it? It's not necessarily being actively traded and rotated on the underlying, or
No, they
not,
they are
not
actively
necessarily?
managed. Now,
Okay.
one of the things I talk about a lot with clients is turnover. And so how much trading is actually done in portfolios? Well, if you look at an open-end bond fund like a Fidelity Total Bond, and you look at their turnover rate, it's in the hundreds of percent, meaning that if it's a $1 billion portfolio over the course of the year, they're doing $3 or $4 billion worth of trading, and that's all. That stuff is a drag on performance. And you know, my old boss, Jerry Paul, who ran the Invesco high yield bond fund for a number of years, he used to say that, when it's an open end bond fund, people would put in the money when everything was up in value and
Right.
pull out when everything was down in value. So he was like a forced seller when things were down and a forced buyer when things were up. And that's it's the opposite of what we should be doing. Whereas a closed end fund, they never have to sell if they don't want to, right? Because they're never having to meet redemptions.
Right.
Okay. And so the portfolio manager can buy what he wants to buy. He can buy the most illiquid stuff that he would like to buy. And obviously the illiquidity premium will pay you a greater yield, right?
Right.
Two bonds that are completely identical. One's IBM and one is, Bill's technology company down the street. Well, even though they're both rated the same credit rating, Bill's is going to definitely, pay you more because it doesn't
Right.
trade very often. And so the closed-end fund's able to go buy those knowing that they never have to sell if they don't want to. Okay?
So these aren't necessarily like bullet style funds that have fixed maturity
No,
dates where they close and wind down. Nominally,
no.
they may be perpetuity funds.
Almost all the funds are perpetuity funds. There are
Okay.
some that are term funds. There's basically three types of closed-end funds: a perpetual fund, a term fund, which has a certain date that it's going to liquidate in the future, and then a target term fund, which has a certain date it's going to liquidate and a certain price that it aims to liquidate at. Okay.
Okay.
But the vast majority are perpetual.
Okay. And it sounds like you're largely buying the perpetuity versions. You're not doing these as term funds or target funds to try to have maturities aligned with certain dates.
Oh, we do both. The
Okay.
term funds have had some great opportunities and outcomes in the last few years because if you can buy a muni closed end that's paying you 4.5% tax-free yield, and it's going to liquidate 3 years from now, and it's trading at a 6% discount, where you're getting that 4.5% yield, and you have that 6% discount that is going to close in the next 2 years because it's going to liquidate at NAV. Well, you're really getting a 6.5% yield on that fund, right? Because you're going to get 2% annually from the discount. Now it's not going to be linear, but if you hold it to its liquidation date, you can substantially outperform what let's call it passive or open-end muni fund would do. So we're playing both. There's actually a lot of funds that are terming out in the next 6 months that we have substantial positions in, because you could really create a lot of additional alpha by buying these funds at even 2% discounts and capturing that over a 6-month period. Well, that's an additional 4%
Right.
annualized.
It's like a illiquidity premium.
Yeah,
I guess like shows up as an illiquidity discount, and you earn it back in a hold to maturity scenario.
exactly.
So
Because
you're
it'll self liquidate on you, and then you can just roll those proceeds into something else.
And so how you pick what to buy, it sounds like, can be everything from you're looking at managers and their results, and I'll call it like traditional evaluate managers scenario. You're looking at holdings because you got to understand what's going on there, especially if it's trading at a discount. You're buying sometimes with predictions or anticipations about whether the discount's going to narrow
Yeah.
by market virtue or because you're holding to a maturity or liquidation. Like this is all coming in. It's still a good amount of security analysis of the closed fund vehicle.
Yeah, I mean, it's all of that above, and I spend the greater part of my day doing all that stuff and looking at our client portfolios, seeing which clients, based on my notes, who is more risk averse, who can tolerate a little bit more of the closed end funds versus individual bonds, and like I said, with most of our clients being bond heavy, that's made a huge difference in their outcomes. So we've
Right.
been happy with it, and it's worked, and it sounds like it's a lot of work, but honestly, it's not. We don't, we're not day trading. We're not, weekly trading. We're buying here and there on the edges when I see opportunity, and we do it in the master account and allocate to the underlying clients. But this is not some strategy where there's this big algorithm or all these computers and servers running things. It's really not that much, additional labor.
So then help us understand what this I guess adds up to in terms of the advisory firm as it exists today.
Mhm.
So like assets under management or clients or revenue or however you measure, like help us visualize the overall practice now.
So we manage a little over 322 million for 160 client households. Um, we've grown pretty steadily over the last few years. We did, like I said, pull out of Northwestern, went to Schwab. Some clients did stay with other advisors at Northwestern when we did that, so we had to make up some ground because we had some joint work arrangements with other advisors, and so we got paid out for some. We bought out other clients for others, so we had a little bit of a step back there in AUM, and we've since gained it back with new clients and obviously asset growth. Most of our clients are baby boomer clients who are geared more towards income. We readily admit, hey, we're not trying to find the next Apple. We're not trying to find the next
Yeah.
Google. We're just trying to get you to that finish line.
And
And so we're a team of 6 now. We just hired our 6th person, and conceivably with the technology out there, we think we can double in size and not need to add anybody.
and uh and revenue overall.
Revenue is a little over 2.1, I believe.
Okay.
Daniel on our team does that. Our fees are actually relatively low relative to the industry itself. We do start out at 1, but it quickly goes down to 0.8, and we do it on.
How quickly? I mean, like where do
So
you get down to 0.8?
so the way the fee schedule works is we don't do it like tax brackets where it's tiered. Like, oh, the first X
Okay.
dollars is. So once you hit a threshold, you get the whole caboodle gets down to that new level.
Okay, so it's like a cliff level. If you hit this number, everything back to
Correct.
$1 is at this new threshold.
So at 1 million, you're basically at we start off at 1, but our average fee right now I think is right around 0.8 or 0.77, and that includes everything with planning and all the things that come with it, right? And we talked a little bit earlier about we have this chart. It's called the iceberg chart that shows, um, you know, people think all we're doing is asset management, and that's the piece above the water. But below the surface, there's, we have a list out of things that we
Right.
do, and there's dozens of stuff that we're doing on a daily, weekly, or annual basis.
And is fee structure just uniform across the portfolio versus do you have we charge this for fixed income and this
No, it's
for
uniform.
equities?
Yeah,
Okay.
uniform. Yep. Yeah.
So as you've gone through this journey, what's
hmm
surprised you the most about the process, like building and scaling up the advisory business?
Well, I mean, obviously going independent was tough, and I had some personal challenges at the exact time that we were doing the move
Oh,
out of
how
Northwestern.
fantastic! Yeah.
Yeah, perfect timing as always, right? And so that threw a little bit of a monkey wrench in things. So overcoming that was a little bit more than I had planned.
So what
Go ahead.
surprised? Like, was it surprising that going independent was tough? Like, did you fear it, or were there things that blindsided you as you went in compared to what you were expecting?
So I had worked at an RIA prior to being at Northwestern, so I kind of knew the RIA space prior to our going independent. So there was no like fear of, oh, what is going independent? We're not going to have this back office support or anything like that. It was more of a fear of, are the clients going to come with us, or are we going to make a big mistake or some kind of big error? Things that you didn't have to worry about prior are now things that you kind of have to have front and center, in addition to the normal things of managing a financial advisory business. And I credit Chris, who's our CEO. He's taken it all on and done exceptionally well at managing some of these hurdles that have come across more from a managerial perspective. And then, from a portfolio side, our move coincided with this big bond bear market, the markets, the equity market itself going into a bear market. And so, it was from a market standpoint, not a great time either.
Because you left back in 2022 when
Correct.
bonds decided to go wonky.
We literally left in the end of September, October 1st, 2022, right as the markets were at their lows, interest rates were at their highs. And so it was, obviously we timed that well. But from a adversity standpoint, we turned it into kind of a benefit, because one of the things at Northwestern that was exceptionally difficult to do was buy individual bonds. And we didn't really talk about it too much, but once we left Northwestern, again, remembering this October of 2022, the 10-year just crested over 5%, right? And you have this opportunity to kind of lock in these high yields, not knowing that you're at the highs, but knowing that they're pretty high relative to the last 15 years.
I would say it looked a heck of a lot better than it had for a long, long time.
Exactly. And so for the first time, we're able to actually buy individual bonds. And for the first time in 17 years, they actually look good enough to buy. And so we've turned that kind of, let's call it lemons, into lemonade by going out and starting to shift our bond portfolios substantially. Because at this point, I had really reduced, the year prior, really reduced our closed-end fund exposure because the interest rate risk was so significant. I mean, I could see the Fed was starting to raise rates. I didn't think they'd go to 5.5, but not knowing, I'm gonna err on the side of conservatism and sell down my closed ends. And so, when you started selling those out and you say, okay, well, where is the opportunity? The opportunity was going to the individual bonds, because we were able to buy I was able to buy BBB plus A- corporate bonds with a 6.5% yield. And, 2 years earlier, you couldn't even get a single B junk bond for that. And so, where there's adversity, there's also opportunity. And so we were able to overcome that and really take advantage of it and turn it into this great, almost marketing tool. Not that it wasn't, a huge advantage for the client, but, we were able to say, hey, look, we're able to lock these yields in for the next 5, 10, 15 years. And if rates go down to zero again, your fixed income is going to earn that 6.5% for the next 5 to 10 years, while everybody else is earning 2 or 3.
Were there any second thoughts when you were in the midst of the transition, watching bond market get crushed at the time?
Yeah, I mean, there's always those second thoughts, and there's always, I guess it wasn't so much as on the transitioning part, more so about the portfolio positioning part. And so, a lot of people second guess themselves, and you're always like, oh, well, I should have done this, or I could have done that. And one of the things I've been studying for the last several years, five plus years, is behavioral finance. And one of the things I like to focus on is, not with just myself, but with clients as well, is minimizing regret. So how can I most minimize regret for myself on the portfolio side, but also for the client? Okay. And so, I tend to not to be too backward looking. I tend to be more forward looking and saying, okay, well, where's the next opportunity? What is this market giving us that it wasn't giving us, 6 months ago, a year ago, and really looking at the challenge as the opportunity.
So you've done this for a long time. I think you said you were going all the way back to tech crash in
Hmm.
2000, 2002. So as you reflect back on the whole journey, what was the low point for your career?
Oh, I mean, I would say I've had a few low points. I'd say a couple of the big ones were, I was the last employee hired at Janus after Elliot Spitzer, who was the Attorney General of New York a long time ago, before he was even governor. Um, issued his market timing, market trading, the where people were trading the mutual funds after hours, issued that report, and assets just flew out the door. And I had just moved from Boston to Colorado. I starting a family, and it was kind of that, oh my god, what am I going to do type of thing if I lose my job.
So
That was
basically,
a low point. Go
you
ahead.
moved to an asset manager right before the New York Attorney General filed suit against them.
Correct. I was the last
Cool.
employee.
Because I'm going to assume they really didn't do a lot of hiring right after that.
There was a hiring freeze for 4 years following that. That shows you how much money was going out the door from
Wow.
Janus. And if you remember Janus from the '90s, they were taking in $1 billion a day at certain points. And Vanguard does that today, but back in the '90s, that was a lot of money coming in the door. So these guys were spending money and flush with cash everywhere. And for that to change, it literally changed overnight, with that suit being filed.
Right.
So that was a low point. '08, it's hard to overestimate that, because you have every single asset falling so substantially, and your revenue as a firm dropping along with it, right? And so you never know if your job is stable at that point or not. And I had
Sure.
only been with the RIA for about a year and a half when that happened. Um,
I was going to ask, were you still at Janus at that
no,
point, or
I had moved
you?
on to it. I knew at some point I wanted to move from the institutional side to the wealth management side. And so in early '07, I had moved from Janus um, to an RIA. And you know he my boss there had hired two portfolio managers, or junior analysts, let's call it, at the same time. And so then, a year later, you had the financial crisis, and everyone's like, okay, well, revenue is down 25%. Someone's getting cut here. And of course, you're
Mhm.
at this. You're not sleeping. You're worried every day that today's the day. And so that was a pretty big low point.
So,
Um, Go
so
ahead.
I'm curious, is like you went to Janus and the Attorney General filed suit and assets dropped. You went to the RA and the market crashed. Like, did anything really bad happen when you went to the next firm?
So honestly, joining Chris and Chris's dad, really, at Northwestern, that was probably the one of my high points, I would say, because no, we didn't. This was what was it, late 15, I believe, or early 16. Yeah, there was a little bit of a bear market going on at that point, but in reality, I was able to kind of take the tools and the things I learned, both on the institutional side at J.P. Morgan and at Janus, and then at the old RIA side, and take those tools to, what I would say is, it was. Bob ran a great firm, but he was still within the Northwestern system, so it was a little archaic the way portfolios were managed. And so I was able to use those tools that I had gained to kind of, let's call it, modernize a little bit of the portfolios that he had already built up in the firm.
Because I
So.
guess particularly like 10 plus years ago, just the brokerage side wasn't as built out. The advisory side wasn't as built out.
Correct. Yeah, and like I said a little while ago, it was a bunch of mutual funds, American funds, and like total bond funds or total return funds, and when you have a $5+ million client, and you're in kind of that generic total return fund, or that generic large cap fund, those clients are very, I would say, at risk, because someone's going to come along and say, a $5 million client shouldn't be in open-end mutual funds, and then you're at risk of getting those clients stolen away. So when I say about modernizing, it's about moving those clients towards kind of where the big boys are playing, and protecting yourself really as a firm from losing those clients.
So out of curiosity, just I feel like so much of the industry dialogue these days is the move from insurance and brokerage towards RIA.
Yep.
Just I'm fascinated that you were at an RIA. It sounds like you were at an RIA in the late 2000s, early 2010s. You went
Yep.
to the insurance company, like to a practice within Northwestern. So just what drew you to the practice or led you to make the shift there?
Honestly, it was the people. I met with the group and really enjoyed talking with them and meeting with them and and knowing that at some point, they were not going to be at Northwestern, and knowing that I could help them not only modernize the portfolios but help them with the move if and when that actually came. And honestly, it was the people. That's what drove me to
But
them.
interesting. But it sounds like it wasn't like they wanted you to come in because they're about to break away. Like
No.
you went in 2015, 2016, and I think you said like the transition happened 2 years ago, not
Right.
even.
Right.
So you
Yeah,
were
there's
six plus years at the insurance company.
correct.
Okay.
Correct. So yeah, a long runway between arriving and actually
Yeah.
leaving, but sometimes that stuff takes a long time.
Oh yeah. It's a big
And
change.
and we prepared for it.
So anything else now you wish you could go back and like tell you from 10, 20 years ago about like navigating your career and building a firm?
Focus less on the minutia of things that a year or 2 years from now you're going to look back and say that was completely meaningless.
Well, yeah, but you don't think it's going to be at the
You don't think about the
time.
time, right? And so one of the things that I look back on is it's events in the markets, it's events when with certain clients, and I think about it, and even to this day, I have clients that if we ever have, we don't get clients that leave very often, but when they do, I take it personally. It's one of those things that you say you don't want to do, and a lot of times it's not anything that we've done. It's someone died or things outside of our control, but it happens, and it's one of those things that no matter how many and like I said, I study behavioral finance, and I spend a lot of time on the psychological aspect of this business, and you still have, even with all this knowledge, you still have a hard time overcoming these things. So that's one thing I try to not do is just don't focus on the things that are not going to be material a year or so from now.
So any other advice you would give younger, newer advisors like coming into the profession today and trying to get started on a good foot?
I think be knowledgeable of the markets. I think a lot of times advisors, they come into this business and they say, well, I don't really need to know I don't need to be a CFA in terms of my knowledge, and can just get by with just knowing the basics. I find that to be, a little bit like, being a doctor or a surgeon and just kind of, stopping after, biology 101. You should always be a product of the markets and know them. You don't need to maybe be at a CFA level, because you're not going to be, running a hedge fund, but you need to be able to discuss them and know the risks that your clients are being exposed to. And I think a lot of new advisors are really missing that opportunity to study the markets, and focus on not just the planning aspect of it, but the portfolio management side. There was an advisor at Northwestern who was kind of one of their bigger advisors, and he used to say that the asset management side is commodity business, and you don't really need to focus much time on it. And I used to think, God, that's like the opposite of what I think is reality. And so I kind of push younger advisors to really study the markets and study kind of market history, really, and focus a lot on having that knowledge in the back of your head, because clients, they can sniff out when you don't really know much about certain things, and if you don't really know much about the markets, they're not going to really trust you with their hard-earned money.
Are there particular, I don't know, resources or programs or books that you like for that? I guess for those who not necessarily want to go all the way down the CFA path.
Yeah, I mean the CMF in terms of a kind of a designation, I think is a really good one for
From CIMA from Investments Wealth Institute.
Correct. And kind of knowing that information, I think it gives you a good foundation, a little bit of a slightly above average foundation of the markets. But I mean, there's so many good books out there. I like Howard Marks's Mastering the Market Cycle. I think that's a great book for conceptualizing the macroeconomic piece of markets and bringing it down to kind of a portfolio management level. Ray Dalio's Principles book, I think, is a great one. There's so many out there, and Morgan Housel's Psychology of Money, I think, is a great one from a psychological perspective. So there's just so many out there. I have clients or advisors will say, "Oh, what about the Intelligent Investor?" Honestly, I don't find that book all that helpful for what we do. I just, I think it's overplayed. Same thing with like Went Up on Wall Street from Peter Lynch and things like that. I want books that kind of make you think about what the markets are doing, why they're doing it, and how it relates to client portfolios are the ones you kind of want to focus on. And so I spend a lot of time on like I said, the behavioral side and the macro side.
Interesting. So as we wrap up, this is a podcast about success, and just the very word sometimes success means different things to different people. And so you're on this wonderful growth path with the firm, $300 million and rising. So the business seems in a wonderful place now. How do you define success for yourself at this point?
Well, I think for us, success is more so than just growing assets and growing revenue. Well, obviously that's our goal, and the three partners at our firm are all fairly young. I'm the oldest at the firm at 46, and so we have big aspirations in terms of how much assets we want to bring in. That is not how we define success. Success for us is really, for one, stewarding our clients to their objectives and doing so in a way that doesn't keep them up at night. I feel like that's a huge part of our business. I think it was Roger Whitney who puts out a retirement blog on a weekly basis. He had a great quote where he said, just because a certain portfolio gets you to your objective, is it worth it if you have to white knuckle it the entire time?
Right.
And to me, that quote said it all, because I feel like a lot of clients of other advisors, let's say, or do-it-yourselfers for that matter, are white knuckling a lot of the time. And so for us, I think success is more on not having them white knuckle it. But also, from a firm side, we are a PBC firm. We're not an LLC. So it's a public benefit corporation. And so giving back to the community is a big factor in our business. And so this is something that we're just really implementing, but we want to do, we want to give a certain percentage of revenue each year to charity, and we want to commit a certain number of hours each year to a charitable endeavor, like, building houses for underprivileged people or things like that. So to us, success is really how much we can also give back to the community.
Very cool. Very cool. Well, thank you so much, Mark, for joining us on the Financial Advisor Success Podcast.
I appreciate you having me.
Absolutely.
Want even more ideas, tools, and resources on how to break through to the next level of success as a financial advisor? Check out the leading financial planning industry blog, Nerd's Eye View, at www.kitsis.com. where Michael covers the latest practice management trends and financial planning strategies. And by joining the members section, you can earn IMCA and CFP continuing education credits, along with exclusive member content. Get it all now at www.kitsis.com.